You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, Hamish. How you going this week? How's the new place holding up for you?
I'm doing well. It's really good. We're finally kind of starting to settle in a little bit. I think it's still going to be a bit chaotic for maybe a week or so more, but finally settling in. Got the new or at least most of the new set up, so I was able to sort of make a new video, which was
I saw that
in the new set, which was exciting.
So do you reckon that's going to be the camera angle that you stay with, or are you going to mix it up, or does it still need further tweaking, or what's the go?
Yeah, I don't know actually. I think over time I'll certainly change up the camera angle just because it kind of gets boring, I think, filming in the same direction, and it's kind of nice to change things up and make it a little bit more exciting. But certainly I think it's a little bit plain at the moment, but considering my previous background was just a white wall, it's a lot less plain already. So it has been upgraded, but there's still a few more things I want to sort of add. But
no, it looks good.
Yeah, we'll see how that goes over the next couple of weeks or so, I guess.
Yeah. No, it looks good. It's a nice set. I reckon you chuck some like artwork or something on the wall there, or some bookshelf, and then that's premium. Yeah,
exactly. There's on the right side of me on the video, it's all sorted. There's the Mac, and I could probably put something on the screen. I got the light. On the left side, it's still just a blank wall, so I've kind of got to figure out what I want to put there, whether I put a poster up or put a plant there or something like that, something just to fill that space. But
it's all coming together. Looks good. I like this kind of stuff. I like this whole set design. It's actually interesting how many YouTubers, they really put a lot of effort into their kind of set design and what their video looks like, as well as what the content's all about. So that's interesting. It definitely makes a difference though, like as opposed to having just a white background versus having some stuff back there.
Oh, definitely. Yeah, I think people definitely can tell the difference, and they mention it in the comments as well. And I think designing a bit of a set is sort of one of the more fun parts that I find from making content, but I'm also terrible at it. So I always have to get help from people who actually know what they're doing. Some friends in photography or any other kind of visual arts.
That's funny.
It's good to have friends like that. But
exactly.
I think it turned out quite well so far. So we'll see how it goes.
All right. Well, let's get stuck into it. So today we've got a couple of news stories to get to, but we want to free up some time in this podcast to get through a lot of Q&A questions, because we've just got a backlog, as we were talking about last week. So I'm excited to get to all of your questions and see what we can talk about today. There's just from a quick squiz, there's a whole range of different topics. So should be a good podcast. I'm keen to get into it. So do you want to take us through the sponsor, and then we'll get into it?
Yes. So surprise. This episode is sponsored by Sharesight. So Sharesight's an application that basically you can use in order to track the performance of your stock portfolio. So it's really great for keeping track of all of the different types of gains. So capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then basically the main reason why I use it is when it comes to tax time. So Sharesight allows you to generate up to 10 different reports that can be used at tax time to easily work out things such as your capital gains, your dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelt SIGHT, sharesight.com/young investors. And if you use that link at the moment, you can also get 4 months free, 4 months off when you sign up to a yearly subcription. So I don't know how long that's going to last for, actually. They didn't tell me.
Oh, really? Is it not forever?
It's not forever. No, it was just a short-term thing that they were doing.
Well, I said this a couple of weeks ago, it's probably a good time to get in now. Like if you're actually thinking about it, it's a good time to get in now before the start of next financial year, so that you have Sharesight running for literally the whole of next financial year. So that'll make your tax stuff so much easier. But yeah, no, definitely recommend it. And yeah, 4 months off. Like, come on, that's that's one of the better. I reckon that's one of the better podcast sponsorship discounts that's going around at the moment. Usually they're like, oh, you can get 2 weeks free. 4 months. Yeah.
It's definitely
awesome.
a top 3 podcast sponsor out of all of the podcast sponsors. Top 3. top 3. Okay.
Oh dear. Anyway, all right. Well, let's get started. What's our first news story?
I reckon we should start with some Phil Town news because this is something that's something that's relevant to our viewers quite specifically because of just sort of the style of investing that we have and how it's sort of based on Warren Buffett's principles, and Phil Town stuff is also very much based on Warren Buffett's principles.
Well, I think I learned I think Phil's books really taught me the true structure of the Warren Buffett style investing philosophy. Like, like Warren Buffett, he always says, we buy great businesses and we buy them when they're at margin of safety price. So I was like, what? I don't get it. And then Phil Town obviously teaches you how to do all of those steps.
Yeah, he was one of those people who just managed to sort of consolidate the strategy that Warren Buffett was, I guess, trying to portray over all of the different letters and all of the different interviews that he's done over the past 50 years or so.
Yeah.
It can sort of be all over the place if you're just sort of listening to what Warren Buffett is saying in one interview to the next interview. So, certainly he was a huge influence on the way that, on sort of directing me towards Warren Buffett's principles specifically as well.
Yeah. Yeah. So we got for those that don't know what we're talking about here. So Phil Town, we got his portfolio revealed because he runs the Rule 1 fund, which is a new fund. And he just released their first annual report to shareholders. So in it, we basically get a letter to shareholders from Phil where he talks about kind of what he's thinking about the markets and his general, thoughts, opinions, and his overarching strategy. And then because it's an annual report, he has to go in depth and talk about the fund. So he talks about, how big the fund is. He talks about what their investments are. He even talks about what their what his options portfolio is as well, which is super interesting. We might talk about a bit more of that in a second. But essentially, it starts out kind of talking about, Phil's kind of thoughts on the market and what his overarching strategy is and why he's doing what he's doing at the moment. And I mean, you could probably guess what he's going to say in this section. He's basically just saying that he doesn't think the market turbulence is over. He quotes a lot of Ray Dalio, what he's been saying lately, how, we could be going into quite a deep recession, kind of what Warren Buffett's alluded to with what he's doing with his investing. So I found that kind of interesting. But then after he kind of spoke about that for a page or 5, then he showed us his portfolio, essentially, as what you have to do in your annual report. So his fund's working with about $66 million. And of that $66 million, he's currently sitting in about 1/3 cash. And then 1/3 is in a money market fund, which is basically cash. And then 1/3 is actually invested. So he's essentially 2/3 cash, 1/3 invested.
Right. Okay. And that money market fund, is that, I presume that's sort of money that he's using or I guess it's money put up for options that he sort of businesses he might want to invest in and he's got contracts out for.
Yeah, I
but
don't know.
he certainly has a lot of cash.
Yeah,
he's certainly not very much invested. And it's fascinating that the market can go down, whatever it did, 37%. And then people like Phil Town and even Warren Buffett, they weren't sort of going out and buying much. I mean, Warren Buffett continued to sell, and it was probably one of the years where he sold more than he's purchased in that year, that he's been a net seller. And I think the same is probably true for Phil Town. So it's fascinating that, and he sort of alluded to that, or he spoke about that in the letter in the annual report, that even though business prices came down a lot, they still weren't anywhere near cheap enough to make a margin of safety, 15% return like he targets. Yeah,
exactly right. Yeah, he did. He talked about that quite a bit, saying we had a 30% drop off in the markets, but things were still overvalued. So that's why it's not like I'm trying to keep my money on the sidelines. Like, I kind of like being an investor, but sometimes it just don't work. He talked about Charlie Munger's classic quote of making money while you wait. Like that's where the money's really made in the stock market. It's while you wait. It's while you're being patient and not, just blindly throwing money into overvalued stocks. But I found the list of companies he invested in is pretty interesting. So his biggest position is in a bank called Bank OZK, which I don't really know too much about, but he talked about it in the report as being kind of like a pretty rule one company. They are fairly conservative and they don't really put themselves in risky debt positions or anything like that. He holds Berkshire. What else does he hold? He holds Boeing. He holds Sturm Ruger and Co., which is a gun company. Ulta Beauty, some fertilizer manufacturer as well that I can't remember the name of. Goldman Sachs he owns, and maybe a couple more that I can't remember. So he's got 10 stocks total, and he's not like a Warren Buffett. You know how Warren Buffett's got like over 50% tied up in like the top 3 or 4 stocks in his portfolio?
Yeah.
Yeah. Well, Phil's not really like that. He's pretty evenly spread across all 10. I think like his biggest position's like 4 million and his lowest is like 1.2 or something.
Yeah, right. I mean, I presume he's sort of just waiting for 1 or 2 of these businesses to become really, really cheap and then go heavy into those. It's probably more of a matter that there's just all of those businesses have probably not sort of reached the prices that he would be really happy to go heavy into.
Yeah.
And maybe if that happened for 1 or 2 businesses, his portfolio would look a little bit more concentrated in a couple of those businesses, whereas he's kind of just evenly in a bunch of businesses that are kind of fairly valued, I guess, based on his opinion on the markets at the moment. But yeah, I thought I don't really know any of the businesses that he is invested in, except of course Berkshire, and I know of Boeing, of course.
Yep.
Boeing, which I looked at briefly, although it's kind of outside of my circle of competence, at least at the moment. And just looking at the numbers, it was always so very expensive.
Yeah.
Just because it's basically a duopoly market dominated by Boeing and Airbus, and it's they've got a powerful brand and it's an essential service that's not going away. So it's kind of one of those businesses where you think that their cash flows are probably going to be fairly safe. And as a result, it's always attracting a really high price. But I need to sort of have a look into some of the other businesses he's got, that gun company and a couple others, and kind of just run through their numbers. And that's something I like to do is when a successful investor sort of, or I guess a guru investor, people are calling them now, buys into a business, just kind of looking through the numbers and trying to see what they see in that business.
Yeah, you kind of reverse engineer it, don't you?
Yeah, just what do they see in this business? How are they identifying a competitive advantage, or what is the management team like for this company, and what does that kind of look like? How do they sound on the conference calls? So that's something I'll have to go out and do over the next couple of weeks, take a look at some of these companies. Yeah,
the interesting thing as well is that he revealed his options portfolio. So because his style of investing is trying to buy great companies and hold them for the long term, what he does is when the stocks are a bit expensive, he writes put options so other investors buy them off him, so that he basically writes put options with a strike price of his margin of safety price. So he can collect money by selling the options. And then if the stock falls to his margin of safety price, then the other investor can just say, it can exercise the option, and Phil will just buy the stock that he was already interested in at his margin of safety price. So it's kind of interesting looking at his options portfolio, because it kind of tells you what's immediately on his watch list. Like, what does he want to buy stocks in? And because it also has the exercise price on there, you can see what value or what share price Phil would be willing to actually sink some money and buy the shares of that company in.
Yeah.
If that makes sense.
It's a really smart strategy because particularly if you're operating in enough volume, so you're buying enough shares, because with options contracts, you need to be buying shares in lots of 100. So for a lot of shares, you're talking about selling a contract that would mean that you would have to buy, or you might have to buy maybe $20,000 worth of a stock if it hits a certain price. But they're really smart because in the meantime, if the stock doesn't hit that price, then you just collect the premiums because people are paying you for these contracts. They're paying you for the option to sell, purchase that stock or to sell that stock to you at a certain price if it's a put option.
Yeah.
I always get confused with options contracts because
it's so
a put
confusing.
option is the option to sell and a call option is the option to buy.
Yeah.
But what Phil is doing is he's writing those options. So he's actually on the other side.
So we always talk about options from the perspective of the person that holds the options contract.
Yes,
we never really talk about it from the perspective of the person that is selling the options contract to someone else. So that's why it's all a bit backwards.
It can get really, really confusing. Yeah, I guess the person who's buying the contract has the option, whereas the person who's writing the option is obligated.
Yeah, that's a good way of putting it. Yeah. But yeah, overall, like, this is super interesting annual report, especially because, you know, we follow Phil Town. Well, I follow Phil Town, have done for years and years, and I guess he's really the key figure that really got me into proper Warren Buffett style investing. So definitely check it out. It's public information, so you can just go to the SEC website. You can look up the Rule 1 fund. I think the ticker is RULRX. Ruler X, I think. So if you want to look that up, then you can do that. Anyway, let's move right along. What's our next story we've got?
Where should we go? Let's go closer home to Australia. So one thing I saw in the headlines this week was, so Melanie Perkins is the co-founder of Canva.
I saw this as well.
Yeah, so I guess maybe I'll introduce what Canva is just before we talk about this story. But Canva is basically like, it's basically like an online version, a simplified version of Photoshop. I don't know, do you use it for anything?
No.
Yeah, so I actually use it for all of my thumbnails on YouTube.
Oh, really?
And yeah, even though I have the Creative Cloud suite for video editing and for running this podcast, so I have Photoshop, but I just find that it's, I don't know, I'm not very, I don't really know how to use Photoshop in the best way. I haven't really gone out and learned all the different things that you can do with it. So using something like Canva is just a lot more convenient.
Right.
But it basically allows you to do sort of visual design things. So the co-founder actually became Melanie Perkins and her partner, who's the other co-founder. That's another story that's interesting. They are two partners who co-founded a huge Australian company. But she basically became the third wealthiest woman in Australia after the company raised some more capital this week. So it's a private company, so their valuation is kind of only set when they raise capital. It's not like there's a stock price that's just always sort of going up and down. It's just if they raise capital at a certain valuation, then that becomes, air quotes, the value of the company, because that's the price people were valuing it at most recently. But basically, so they founded the company in 2014, and most recently they raised $60 million at a $6 billion US valuation, which equates to $8.7 billion of Australian value. And her husband have a 30% stake combined. They have 15% each, which values their stake at 2.6 billion Australian dollars. And of course, for each of them, that means that they are now each a billionaire.
Yeah, that's crazy.
$1.3 billion each. And I think I had a quick sort of look at the list of the richest people in Australia, because I've actually honestly never looked at that list too much. But having about $1 billion to $2 billion puts you in about the top 30 of overall richest people in Australia. But in terms of women, Melanie Perkins is the third wealthiest woman now.
There you go.
Which is a huge achievement.
Yeah, that's awesome. And I think she's like 30, 32, I think.
Yeah, she's 32.
Young.
Yeah. So she founded the company, 6 years ago when
Holy
she was
moly. 6
26.
years.
she's 26 and I think her husband was 28 or something like that.
Whoa.
So together they just founded this company, and then 6 years later, they're both billionaires.
That's crazy. 6 years, $1 billion each.
It's pretty insane.
Wow.
Yeah. And it's one of those businesses where there's just so little fixed costs that it's one of those businesses, if it takes off, it can really just go big. And I was having a look at some of their numbers, and we don't have a whole lot of data out just because it's a private company. So it's kind of what leaks out or what this investor says. So there's not really, there's no sort of website you can go to and just find out what their latest revenue numbers were. But we can do a little bit of estimating. And basically, I found in one article that they had 1.5 million paying subscribers. So these are people who are paying between $10 to $30 per month, depending if they're an individual or an enterprise subscriber. So they have 1.5 million paying subscribers, and they also have 30 million monthly active users. So I don't pay for the subscription. I just use the free service. But there's a substantial amount of people who use the free service, and then they've got a fraction of those who then go on and pay for their premium services, which I honestly don't even know what their premium services is, because their free version is so good. Yeah. Well, I know I was just going to say, I know I've given them some money in terms of, like, they have some like stock photos and I guess symbols and that sort of thing that sometimes it's just the best thing for a thumbnail. So I just pay whatever it is, $1 or $1.50 just to use that. But in terms of what the subscription offers, I actually don't know what it is. Maybe you get access to a certain number of those stock photos and stuff as a part of your subscription.
But geez, that's a pretty impressive effort. Good on you, Melanie Perkins, third wealthiest woman in Australia. I want who? So Gina Reinhart would be the top, right?
Yeah, and she's the wealthiest person in Australia as well.
Oh, is she? Okay.
Yeah, so she's both, and then she's worth about $16 billion.
Right. I wonder who's second.
I can't remember.
Doesn't matter. Anyway.
Off the top of my head, but there wasn't many that had above 10 billion, and then there was just a ton that had like 1 or 2 billion. So if this company grows, if this company continues to get funding at higher and higher valuations, and maybe it goes public and it goes even bigger, then there's a good chance that these two could move really seriously high up that list.
It sounds like they're doing a great thing.
Because, of course, being the 30th richest person in Australia is not good enough.
No, it's not good enough.
No, you need to be top 5 at least.
Yeah, definitely. It's all about that street cred. 30th richest? You've only got 1 billion. Please stop wasting my time.
It is kind of funny, though, because they only raised $60 million. They sold whatever that is, I think maybe 1%, or maybe it's even less than that. I can't do maths in my head right now, but about 1% they sold of their stock, and that was able for them to raise their valuation their valuation in October last year was under 5 billion, and now it's at 8.7. So that's like almost 100% increase in the value, which is obviously driving their wealth. So the price they would have paid for the shares that ended up totaling 60 million just would have been much higher. Yeah, exactly right. Yeah, but I thought that was an interesting story.
Yeah, that is really interesting.
To talk about.
Far out, billionaire in 6 years. Yes, please.
Yeah, so we'll have to keep track of them and see how they go, and see whether they go public at some point, because the company's getting to the size where they probably might consider going public if they needed the funding.
If they needed it,
they're estimated to make about $200 million in revenue this year.
Right.
So they're starting to get to the size of a company that you might then see go public. But I guess we'll kind of see what happens with that.
Yeah. All right. Let's move on to the next news story then. This is a sadder one. Qantas, they are going to axe over 6,000 jobs.
Oh, yeah. I saw this. Brutal. Just came out this morning, didn't it?
It did. Yeah. So I just thought I'd chuck it in. Yeah. So Qantas will cut about 6,000 jobs, including cabin crew and ground staff, as it becomes a, quote, smaller airline in the short term to deal with the fallout from the COVID-19 crisis. These jobs will be cut across Qantas and Jetstar and represent about 20% of the company's workforce, so a substantial percentage. Qantas made the announcement this morning as it entered a trading halt ahead of a share sale in the company. So the CEO, Alan Joyce, said, "We have to position ourselves for several years where revenue will be much lower, and that means becoming a smaller airline in the short term. Most airlines will have to restructure in order to survive, which also means they'll come through this leaner and more competitive. For all these reasons, we have to take action now. Adapting to this new reality means some very painful decisions. The job losses we're announcing today are confronting. So is the fact thousands more of our people will thousands more of our people on stand down will face a long interruption to their airline careers until this work returns." So
That's rough.
Yeah, it is pretty rough. I mean, 20% of Qantas workers, that's a lot. That's a very high percentage.
Yeah, I saw in his statement that he was saying that many of those staff members are people who have been at Qantas for over a decade.
Yeah, long time.
So it's not even just, you're not just talking about maybe people who they had just hired in the last couple of years or so, and they just need to get a little bit smaller. You're talking about people who have been, at this company for over a decade. So they've spent a substantial amount of their life there. And have sort of contributed to the growth of the company. So it's always sad to hear these stories. And it's just been one of those industries that have just been slammed by what's happened. And we spoke about sort of the financial health of Qantas and Virgin a few weeks ago, I think. And I think Qantas was in a little bit better shape.
Yeah,
I mean, clearly they were in better shape because they're not they're not facing bankruptcy. But
yeah, true.
It just kind of goes to show that there was airlines that kind of, or especially in the US, that kind of pushed it a little bit in terms of the share repurchases and taking on debt. But even the companies that sort of were obviously trying to have a very strong financial position, even them are sort of having to do things such as to lay off a lot of workers and restructure and facing the fact that they're going to generate a lot less revenue and a lot less profit over the next couple of years while things sort of get back to normal. But yeah.
Yep, it's unfortunate, but I just don't know what else the airlines are going to do. I mean, they have to cut costs; they just have to. Yeah. So it's kind of necessary that they either get bailouts or they start cutting workers. So, but yeah, it's never a nice story. Anyway, should we move on? Do we have anything else to talk about?
Yeah, we've got one more. And
right.
I guess this sort of relates to another, not a struggling business, but a part of a business that was struggling.
Right.
So Microsoft had a streaming service. I didn't even know this streaming service existed. Did you know about Mixer?
No, I had no idea.
Yeah, so apparently I never knew that this thing called Mixer existed, which was basically Mixer was basically Microsoft's attempt to compete with YouTube, so Google's YouTube,
right,
and Amazon's Twitch, so Twitch being both of those offering sort of gaming streaming, which is where Mixer was sort of targeted. And they're actually going to be shutting it down, and Facebook is coming to the rescue. And
right.
Well, not really, but Facebook's sort of picking up some of the pieces, and they're actually going to be going into a partnership deal that will hopefully benefit both of those companies. But basically, the story with Mixer was that, as I said, they were trying to compete with YouTube and Twitch, and they tried to do this and tried to sort of catch up and gain viewers by signing a number of high-profile streamers. So one, for example, was Ninja, who streams games. I think I don't really I know who he is, but I've never sort of watched what he does. But apparently they signed him in July of 2019 for an estimated $20 to $30 million.
Wow.
So that was a contract that said he had to exclusively stream on their site. And of course, the aim of that is that his huge audience would then come across from Twitch, where he was streaming before, over to Mixer, and that would help Mixer grow. And they did this with a number of other streamers as well.
Yep.
And then just in the last couple of weeks, I think maybe this week, they basically just announced that they're unable to compete in the space. So they obviously tried their best. I don't know how long Mixer was around for. I'm guessing since they signed Ninja in mid last year, I'm guessing it was something that probably only ran for a year or so before they realized that YouTube and Twitch just have too much.
They're too far ahead.
Yeah, and I mean, that's just a story in of itself. In that, it's going to be so hard for anybody to compete with. I mean, Twitch has done a good job at having sort of their own unique twist, which is that it's just streaming. But in terms of video content, it's going to be very challenging for anyone to take on YouTube, I think.
Yeah.
Just because people are reluctant to change, even when. I was reading this article, and Ninja, when he moved over, his audience was substantially smaller. So it's not as if his audience just sort of decided to move over to the other platform. They just kind of left him behind when he moved. And that's kind of how that's sort of played out. And interestingly enough, this is probably the thing that's the most interesting for me out of this, is that so these Ninja and a couple of other streamers, they were in contracts that made them exclusive to that platform. Now they've actually been paid out of those contracts early, and they can stream on any platform they choose.
Wow.
So
there you go.
It's kind of like the best case scenario for those guys. They got paid what they were going to get paid for exclusively streaming on a smaller site for the next couple of years. And their contract's been torn up. So do they just go back to Twitch now?
Yeah, cheers. And I'll get my audience back. That's awesome. Oh, that worked out for them.
I thought that was kind of funny. So Ninja just got a $20 or $30 million payday, and now he might be asked to sign I think he did get asked to sign with Facebook Gaming, which is kind of where Microsoft is going to be teaming up with. But I don't think he took that deal. I think he's got enough money for now or something.
Yeah,
That's what he said.
He can probably retire pretty comfortably with the cool $30 million.
Yeah, it's not a bad payday, right? I mean, it's been 6 months he's been on that. Oh, maybe 12 months now. Wow, this year's been flying by, but it's been 12 months since he signed that deal.
That's crazy.
It's a huge
just
payday.
For playing video games. That sounds like a pretty good life.
That's it, kids. Drop out of school and play video games. Don't do that.
All right. So I think that kind of rounds out the week of news. We wanted to leave the rest of the podcast for Q&A, because we do have a lot of Q&A questions to get through. So should we get into it?
Yeah, absolutely. Yeah. So, I'll read this first one to you.
Yeah, sure.
So how do you analyze the market each day, seeing stocks like APT, Zip, and Web make huge gains, but still remain patient and resist the temptation of buying into them?
Yeah. So I don't think I follow the markets too closely day to day. Like if something big happens, or if there's a big stock that's moving quite rapidly, then we're going to hear about it. But how do I resist the temptation of buying into these companies that are, bouncing up or down or all around? Well, I think I kind of go back to that unwritten rule of investing, where if you buy a stock, it's going to go down. And if you leave it, it'll definitely go up. So I kind of always go back to that rule, even though it's not actually a rule. But I just try and be patient and wait for the margin of safety prices, because I know that if I buy it too high, it's just gonna drop as soon as I buy it. So I don't know. I feel like maybe my investing I'm pretty cool, calm, collected. I don't mind waiting on the sidelines. I see a lot of my friends kind of feel that kind of fear of missing out, but I don't really feel fear of missing out too much. I mean, you can see a stock that you are almost going to buy, and then it shoots up to the moon, and of course you're like, God damn it, if only I'd bought. But I think I just go back to what the best investors in the world say, the Warren Buffetts and Charlie Mungers and that sort of stuff. I mean, you will do much, much better over a very long period of time if you just chill out, remain patient, only buy when you see the margin of safety prices. Don't get caught up in the short-term stuff. Don't get caught up in the week-to-week. Afterpay's gone up 15%. Webjet's gone down this amount and it's going to rebound 30%. I just don't get caught up in that. You're going to do substantially better if you stay pretty conservative and stay patient and wait for those margin of safety prices. That's kind of what I would say to that question.
Yeah. I mean, there's lots of things that happen in markets that I don't understand. And when stocks are they have no earnings, or their price to earnings ratio is 150, and they're continuing to go up at 30% per every single week for an extended period of time. I mean, I don't understand that, so I'm not. It doesn't bother me. It's not like I'm worried about missing out on that, because I know that there are opportunities that I will understand, and when they come across, I'll be very confident going into them. I think a lot of people do feel that kind of pull of missing out on a business that goes up a huge amount in the short term. But even if you get in on a business that goes up a lot in the short term, if you don't understand why it went up, or if it was a complete speculation, then even though you've made some money, it's going to be a negative for you over the long term, because you're going to think that that's something that's normal, or that's something that's repeatable. And typically it's something that's not repeatable. Unless you get very, very lucky. In that case, good luck to you.
You're right. You're right. If you're buying those kind of businesses and you're speculating and you're not quite sure why it's going up, then sure, you're gonna buy sometimes, and you'll catch the stock halfway up the slope. In which case you go, oh, come on, that's awesome. But if you're not sure why the stock's going up and you're buying into the stock, then the other half of the time you're going to buy it at the peak, and it's going to come crashing back down on you. So yeah, that's why it's just important to, be patient, invest within circle of competence, and, just wait for those margin of safety prices.
Yeah, I think definitely one of the reasons why I'm not sort of, drawn into this sort of thing is because when I was just getting started into investing, the whole Bitcoin bubble was really popping off, and it wasn't something I was involved in. But I felt, because I was so new to investing and it was so exciting, and I was watching how much Bitcoin was going up, it was kind of like I felt the pull of wanting to get involved in Bitcoin, and then I kind of didn't, but luckily I didn't, because the point at which I probably would have got involved in Bitcoin would have been right before it was a disaster. So that was kind of a good learning lesson. Even though I wasn't involved in it, I didn't buy into it at all. But just watching it from the sideline, I could sort of get a lesson out of it. Yeah.
No, I'd agree. Yeah, Bitcoin's the perfect example there. Man, it shot up, but it came crashing down just as hard. I haven't actually looked at Bitcoin in forever. I don't even know what it's doing right now. But
I don't know.
Good luck to all those Bitcoin investors.
Good luck to you.
Good luck. I mean, seriously, good luck. I hope you make money. I hope it's the next big thing and you'll make a lot of money, but it's just not something that I'm interested in. All right, let's go to this next question. Wait, did you? Yeah, you asked me that one, so I'll ask you this one. Every time I look at investing my money, I get analysis paralysis. I like that. That's cool.
Yeah, I like that. I like that
paralysis. Every time I look into investing my money, I get analysis paralysis with all the possible avenues to go down. How can I make this less overwhelming? What are some steps to dig through all of that info?
Yeah, that's a good question. I think what Brandon, you've just sort of listed 4Ms and Phil Town here, and I think that's why Phil Town's books are so valuable, is that he does kind of help you get through that analysis paralysis by sort of breaking down what are the core principles that you should be focusing on, and we both sort of talk about some of those core principles on our YouTube channels and try and break it down into those 4 buckets, which is starting with businesses we understand, and then looking at businesses with economic moats, with competitive advantages, looking at the management team, and then looking at the price. And I mean, in terms of analysis paralysis, I guess where to get started, I would just come up with a list, and this is sort of the Phil Town way of finding businesses. Come up with a list of areas you're interested in, so things that you like reading about, and that you would, it's sort of not too much effort for you to learn about what a business's products and services are, and how they sell them, and that sort of thing.
Yeah.
Find those businesses and just start there. Start learning. Start with an annual report. Go through and just every time a question pops into your head that you don't understand, just try and answer it. So like if a business is selling physical products, for example, let's say you're talking about Apple, they're selling iPhones, and the question pops into your head, okay, well, how do they manufacture them? Well, it's probably in the annual report somewhere where their manufacturing centers are, or what are the main materials that go into it, and how do they advertise their products, and what's their strategy there. And you kind of just have, for me at least, it's kind of like I just wait for questions to sort of arise. And the more reading you do, the more questions come up. And then just using Google and using the annual reports and trying to find the answers to those questions and get as a clear as picture of that business as possible. It's kind of like trying to improve the clarity, like getting a little bit more focused into what the business is doing by just continuously learning and answering those questions. But it can certainly be challenging, nevertheless, when you're getting started, to know where to look.
I think so if you've got a stock that you want to look into, the way to get over all of the massive amounts of data and information and financial statements and all that's going to be pushed into your face, when you're first getting started with a stock, the question that I always ask myself first before anything else is, how does the business make money? And then that's actually not too hard to answer, because it's in the first section of the annual report where the business the management team has to provide a full description of the business. So take the time to read through that first section of the annual report. Ask yourself, what does this company do? How does it make money? And that's the first kind of big step into understanding the business, and then from there, like what you're saying, all these other questions arise, like, where does this company sit in its industry? Does it have a competitive advantage? It makes a lot of money, but what about the other companies? Are they making even more money? Or you go down all these little kind of nooks and crannies. But generally speaking, to kind of get over that flooded, like the sheer volume of information that's in something like an annual report that goes on for 100 pages. You just have to have some sort of structure to the way you're approaching the problem. And the first step, as I was saying, just learn what the business does and how it makes money, and then go through your 4-step process that Phil Town talks about, that Warren Buffett, Charlie Munger talk about. You got to understand the business, then you have to try and work out if it's got a competitive advantage, then you have to check if the management team is operating with skill and integrity, and then you have to check that the shares are at a discount to intrinsic value before you buy them. I think that those 4 overarching steps, like there are a lot of sub questions under each one of those, but they're the 4 overarching steps in that order that you should go through to get yourself up to speed with the company.
Yeah, I think that's a really good answer. And in each of those categories that you mentioned, those 4 categories, it's not as if there's a set list of things that you could find out. It's like you could go as deep as possible. And it's kind of like over your investing lifetime, you will hopefully, if you're getting better, you will progressively dive deeper into each section and get a better picture of each section. But
definitely.
Certainly when you get started, it can be overwhelming to figure out what's even important to look at.
I will give myself a little bit of a plug here, because it'll genuinely be helpful. If you really do suffer analysis paralysis and you just don't know the step-by-step approach, if you want to look at individual businesses, I definitely recommend looking at Introduction to Stock Analysis on Profitful, because that is those 4 steps broken down, and video after video after video, just completely explaining all of the sub steps you need to take for understanding the business, for competitive advantage. And it will give you a step-by-step way to approach looking at a stock, so that you get a pretty comprehensive look at the stock. But not trying to push anything on you, but if that's something that you're interested in, then definitely check it out on Profitful. But
how dare you, Brandon? How dare you? Did you pay for that advertising spot?
No, I didn't, but it will genuinely be helpful.
No, I've been through the stuff on Profitable. It's actually very, very valuable for people getting started and sort of breaking down
bit of support.
breaking down some barriers when you're getting started.
Thank you. I appreciate that.
Oh, dear.
Oh, gosh. All right. We'll cop this question. Can you please explain your own individual circle of competence with examples?
That's a good question. Yeah. So this has sort of changed over time, but there's a couple areas where, and you'll see this in my videos with the examples that I use when I'm sort of teaching stuff. Yeah, exactly. There's a couple that the restaurants most of the time. There's a couple that I focus on quite a lot because I've been learning about them for a long time. One of them being restaurants and retail. And that's really just because I worked in the restaurant industry for quite a while. And if you combine restaurant and retail, I worked for 6 years.
Right.
So that's kind of where that has come from. More recently, I've been looking into sort of digital marketing, just because of my work, because of the business that I run. Looking at businesses like Facebook and Google, and then there's a couple other industries that I've kind of just wanted to learn more about. The RV industry in the US has been an interesting one, just because it's basically dominated by two players, and to me, it seems like again a relatively simple business model. I guess that's probably a couple of the major ones that I focus on. What about yourself?
For me, my circle of competence is probably like entertainment companies, like television and movies and that sort of stuff. So we're thinking like Disney's and Netflix's of the world. Then electric vehicles. Obviously, that's pretty much just one company that's dominant in that area. Social media, so Facebook, Twitter, Snapchat, those companies. Technology products, I love technology. So, I'm across it from, whatever the company might be, like Apple or even like a company like Canon or something like that. I love just technology, electronics, that sort of stuff. And video games, I would say as well. Although if I was really going to get up to speed with the video game industry, I'd have to sink a month or so of pretty decent research into it. That's probably on the outer, but I just play video games all the time. So like I know the companies, I know a lot about it just from without even looking into the businesses yet. But I'd probably say that they're kind of circle of competence kind of things. Like there are a couple in there where I'd have to research them in a bit more depth, but generally speaking, that's what I'd probably say.
Yeah, what you just said about video games is what people should be doing. It's looking at industries where it's almost intuitive which businesses have the competitive advantages, because
you already kind
of
get it.
Yeah, it's kind of like if you're into consumer tech and you're all up to date with which are the best phones, which are the up and coming ones that not many people know about yet, but they actually have the best components and they're the quickest phone. Like if you're just in that, if you just look at that stuff in your spare time because it's interesting to you, then you have such a better grasp of that industry than even an analyst who's had that company just slide across their desk, and maybe they're in finance, but do they actually know what's actually happening at the consumer level in terms of those products and services? So I think focusing on those areas is super important. And I think that's a really good question, actually.
Yeah. Like for instance, going on that, like I've used Adobe Audition or Adobe Photoshop, Adobe Premiere Pro, and what's that funny old one, that PDF reader, Acrobat Reader or something like that?
Yeah.
I've used all four of those programs in the last 24 hours. So, and I know how to use all of those programs. So even if Adobe might not be a great investment, maybe it is, maybe it isn't, I don't know. For me, I've already got a pretty good understanding of what Adobe is offering, and it would be pretty easy for me to then dive in a little bit deeper and actually look at their business in more depth, just because I already get it. Like I'm using their programs, I know what they do, I know what Adobe's about, I know what they offer, kind of thing. So that's a good point that you raised there.
Yeah. Okay. This next question is a short one. What trading platforms do you use for trading internationally?
# sponsored. I use Stake.
Wow. This whole podcast is a sponsorship. I may as well promote my stuff as well.
Yeah, go for it. I think I've answered this one in the last couple of weeks at some stage, but I use Stake for all of my international share trading or investing. I don't trade shares, but I mean it's an Australian company. It's brokerage free, which is pretty cool. So a lot of brokers for international brokerage, they will charge you for foreign exchange, and then they'll also charge you a brokerage fee. But Stake just charges you for the foreign exchange, which is like they don't charge you any more than what a big bank would, but they just charge you that foreign exchange, and then they don't charge you a brokerage fee. So it's pretty good, because their mission is to try and increase the accessibility of investing in the United States markets. So that's the catch with Stake, is that it's only for the US. It doesn't work for the other exchanges around the world, but that's okay because all my international trading is in the US. So
Very good.
What do you use? You use ComSec International, don't you?
Yeah, ComSec International, hashtag not sponsored. Although, email me, ComSec.
Send me an email.
Yeah. No, it's ComSec's, certainly more expensive to trade than stake. There's no doubt about that.
Yeah.
I personally like to have everything in one place. And I also like that Commonwealth Bank has physical branches, and I know that I can call them up and talk to someone relatively quickly if there ever was a problem. Not that I've ever had a problem.
Yeah.
So maybe that's just me being paranoid or whatever, or wanting something that I don't really need. But it's nice to know, at least for me. And that's a personal choice for everyone. For some people, it's stake's going to be a fantastic option for just reducing your costs. And I think for most people, that's probably going to be the way you'd want to go. But
there's trade-offs, right? So you think about, they're running their business, they're not collecting brokerage fees, so they have to save money in other areas. So that's right, they don't have a stake branch in every state that you can walk up to and talk to one of their customer service reps. You just have to email them, kind of thing. So it's not right or wrong whichever way you go. It's just whatever suits your needs out of a broker, I guess.
Yeah, exactly right.
Yeah. All right. Should we go? We'll go on to this next one, hey?
Yeah, for sure.
What do you think about short positions?
Yeah, I don't take any.
No, me neither.
The main argument, I think, for a value investor against short positions is that markets can stay irrational for a very, very long period of time.
Yeah.
And that means that a business that's worth a lot more can stay undervalued for many, many years before its value is realized. And the opposite is also true. A business that's worth nothing, that's fraudulent or whatever, has some other problems going on, can stay very, very highly valued by the market, or highly priced, I should say, by the market for a very long period of time. And the difference between having a long position is that if I'm investing in a company and it stays undervalued for 5 years, what's the harm to me? There's no harm to me, because I don't need that money. So I don't care if the position's negative. I can wait for the market to realize that value. But in a short position, you will be asked to consistently contribute more money to that position as the price goes up, as your position gets worse and worse. And the losses are infinite on that side. So I don't like taking positions like that. I kind of realize that, or recognize, I should say, that the market can be irrational for a long period of time, and that makes short positions very, very scary if markets stay irrational for a very long period of time. If you're taking a short position, you're kind of betting that the market is being irrational, but that it will rectify itself based on some kind of event in the next short period of time.
Yeah, exactly.
If it goes on for too long, then you can lose a substantial amount of money.
Yeah, no, I completely agree. I don't have much to add to that. I've never gone short on any stock. Purely, the thing that scares me is the fact that you can lose an infinite amount of money.
Yeah.
When you buy a stock normally, then the worst that can happen is you lose 100%. But when you have it the other way around, when you've borrowed and sold the shares first, and now to complete the trade, you have to buy them back, there's no limit to how high that share price can go. It can just keep going and going and going. So you still have to buy those shares back to return them to the original owner. So that's scary, that you could just keep the stock could just keep going up and up and up and up, and you still got to buy them back. You've still got to buy them back, so you can just lose more and more and more and more. So, yeah, it scares me a little bit. I just don't like taking those sorts of risks.
It's just another one of those things that is available to investors, but if you don't know how to use it, or you don't think that you can use it confidently, then you don't have to.
No, you don't.
There's so many things that I don't understand. There's so many questions that people ask me about investing, or types of investments, and this and that, and certain terms, and I'm like, I don't know what that means.
I got no idea.
I don't know what that technical chart trading strategy is. Like, there's so many things I don't know about. Just stay in the areas that you do know, and know it very well. That's also, I guess, contributing to why I would stay away from short positions.
Yeah.
All right. So this next question we've got. So you mentioned ETFs and dollar cost averaging. This may be a bit personal, but do you guys have personal superannuation funds?
Do you reckon, does this mean like self-managed superannuation funds?
Yeah, I would guess that's
so. I mean, I've definitely
what,
got super,
Yeah.
but I don't run my own self-managed super funds. Super fund. I spoke to my accountant about it, and I basically said, so do you reckon it's worthwhile starting to think about starting my own self-managed super fund? And the whole time that I was saying that sentence, he was just shaking his head. He was like, no. I think that the reason being is that there's just so much that you have to do in terms of compliance to keep that self-managed super fund going, and for the vast majority of people, it's just not worth it. Yeah. But I'm no superannuation expert, so I'm just kind of relaying what my tax accountant told me.
Yeah. I mean, I don't have one either, and I mean, maybe it's something that I think about it at some point in the future, but honestly, I don't have that much in superannuation just because most of my money's just in my business at the moment. So
yeah, I actively try and keep my money away from super. That might sound a bit backwards, but for people that are really conscious of what they're doing with their money, then putting it away into super may not be the best strategy, because of course you can't get that money for a very, very long time. And plus, I think there are problems with the super system anyway. I think I can vastly outperform it, but that's just me.
Yeah, I was looking at my fees for the small amount of money that I have in super the other day, and it's just ridiculous.
It's just a scam at this point.
I saw an ad, I won't say the fund, but I saw an ad for the fund that I'm in on TV, and they were boasting that they had some of the lowest fees, and I was like, get stuffed. There's no way you have the lowest fees. I was looking at that, bloody 2.5%, 3%.
But generally speaking, for the average Australian, I think that superannuation is a very good idea. Thank goodness that people get made to lock 9.5% of their wage away every fortnight into money that gets invested, and they can't access it until they're over 60.
Yeah.
I think that generally that is a good rule. However, if you're super switched on to where your money's going and what you're doing with your money, then I think the opposite is true, and you actually want to keep money away from super, because you can do so much better with that money than what the super fund will be able to do.
Yeah, most people just can't, most people need to be forced to put money away for the long term. This is the reality. I think people just don't have I don't know. Most people just can't.
It's just short-term thinking.
Exactly. Yeah. I couldn't figure out the way to phrase it, but it's short-term thinking. It's not being able to see why it would be a good idea to start saving or investing for retirement when you have 40 years ahead of you. So I think it's certainly a good thing for most people.
All right, what do we got next? Here's one that's actually specifically targeted at you.
Oh, yeah. Okay.
So, Hamish, were you able to buy more Thor Industries stock during the dip? Had to do a double take that it went from 85 to 32 and is now at 100. I don't know how old this question is, so maybe those numbers have changed, but the question still stands.
Yeah, it's a bit accurate. And let's not forget that it went from 155 to 32. Back in from the start of, I want to say 2018 or 2017.
Wow.
It was at 155, so that's when it kind of peaked, and now it went substantially down. Yeah, so I mean, I've been buying since, I think the very first investment I made was I had that experience of what you described before, where you buy a stock and it goes down straight after. I bought my first investment maybe at about $150 per share or something like that.
Right.
Luckily, it was relatively small compared to my position now. And most recently, I don't know what price I bought in during March, but I more than doubled the size of the investment at a price around probably $30 or $40 per share.
Right.
I was able to pick up some more, but I mean, it certainly went a lot lower than I was expecting.
Man, you have just been killing it with your investments lately. You've just been absolutely killing it. Where are they at the moment? 109, and you got in at 40. And then what's that other one? Corporate travel.
Yeah,
what'd you get in that one? You got in at what?
$7, I think, at an average.
What's it at the moment? CTD.
That one's gone down a little bit.
Still $10.
Yeah.
Yeah, it was up where like $14, $15, man. You've had the good run over the last little while. Well done.
Oh, thank you. Yeah, definitely a bit of luck. I mean, I think I've spoken about this. I've had my fair share of unlucky purchases where as soon as I buy, even though I think it's a good value, that in the short term, it's kind of just gone down. Whereas more recently, I've had a few where it's been on the lucky side, where in the short term, it's gone up from that point. Well, I mean, it depends how you look at luck.
It's just that rebound, isn't it? That recent rebound that we've had is just dragging everything up.
Yeah. And I mean, it depends on how you define luck, because I still have 30 or so % cash. So in reality, I would have liked it to continue to go down so I could put more of that in. But yeah, it is kind of is what it is.
I mean, yeah, just looking at my portfolio, it's basically all just from this market going back up. It's just been dragged up. Tesla's my outlier. Tesla's just gone bananas.
Yeah, it's above $1,000 a share, right? Now
do you want to know my average price for Tesla?
Sure. What is it?
$201.
Oh, that's good.
That's pretty
real
nice.
good. So that's a 5-bagger.
I'm currently 376%.
Well,
that's just stupid though.
done.
Like that's just a spec stock that's done very well.
That's
maybe.
Not like maybe you don't know. I mean, if it don't know how much
I'd take more pride in saying like I'm up 24% on Google and like 68% on Facebook. That's
right,
like I'm more proud of those ones than like a spec stock that just happens to have shot up like crazy.
It's not really based on cash flow or anything.
Yeah, exactly right. Yeah. No, but that's it. I mean, I think that what we've just been talking about just proves the value in waiting and being strict. And then when you've got the opportunity to buy at a price you're happy with, let's go. Like, don't be afraid to buy. Because like, especially over the last, 5 years, opportunities have been few and far between. So
that is true.
Yep. Always make sure you
true.
buy at your margin of safety prices. And maybe you won't get rewarded instantly, but over the long run, you'll certainly be rewarded.
Sound advice from Brandon as we wrap up this week's episode of the Young Investors Podcast. Thanks everyone for tuning in. And as always, we'll be continuing to answer your questions. So if you have any questions, head over to the YouTube version of the podcast at youtube.com/the Young Investors Podcast, or Young Investors Podcast, I think.
Oh, you can't even remember now.
Man, I can't even remember. It's I think it's Young Investors Podcast. We'll go with that. Anyway, you can search it on YouTube and find, just click on the latest episode and just leave your questions there. And if you can keep your questions short and sweet, like sort of the ones we've been talking about in today's episode, then that makes our lives a lot easier. So keep them to short questions, and we'll be happy to continue going through and answer as many questions as we can.
Yep. It is youtube.com/the Young Investors Podcast.
The Young Investors Podcast. There we go.
Yeah.
Thanks, Brandon, for that.
All good. All right, let's get out of here. Thanks very much, everyone, for listening. As Hamish was saying, send us in your questions. We love answering them. And thanks very much for listening. We always appreciate the hour of your time that you give to us every week to listen to the podcast. So we super appreciate it. Have a good weekend, and we'll see you guys next week.
See you guys.